Good afternoon, everybody, and thank you for joining us. This is Josh Mindlin here at Chaikin Analytics, and I'd like to welcome you to our presentation of Improved Client Performance with Smarter Stock and ETF Selection. Joining us today is Carlton Neel, Chief Operating Officer of Chaikin Investments. Please note, Chaikin Investments is not registered as a broker-dealer or investment advisor, either with the U.S. Securities or Exchange Commission or with any state securities regulatory authority. Chaikin Analytics is for educational purposes only and is not a trade advisory service. Past results of any trading system or methodology do not guarantee future results. As a reminder, this webinar is being recorded and a copy will be sent to all registrants. Please submit your questions via the Zoom Q&A window, which you can access in the upper left-hand corner of your screen. With that and no further delay, here is your host, Carlton.
Hey, thanks a lot, Josh. It's great to be with everybody today. I think we have a really good hour set up that will be educational for you. Welcome. Good afternoon. Good morning, I guess, to some of you who have joined us on the West Coast. We'll jump right into it. So, as Josh said, my name is Carlton Neel, and I have now been with Chaikin for about a year and a half. I was an investment manager, a mutual fund manager for the bulk of my career, which started 27, almost 28 years ago now. And as a mutual fund portfolio manager, I got to see a lot of different systems. We utilized a lot of things at Zweig Mutual Funds. As it says here, I was actually mentored by Dr. Marty Zweig. He was also a good friend of mine. I learned a lot from Marty. Two of my favorites are The Trend is Your Friend, which some people also talk about the idea that don't fight the tape. So we learned at Zweig, don't fight the tape. The other thing is beware the crowds at the extreme. And we know as a fact that sentiment is something that is very valuable to look at. And that's going to be relevant as we go through and talk about what we need to be looking at in this market and how that will affect your clients' portfolios. So I was a portfolio manager for nearly 21 years. And why that's relevant, I think, here is that I've spent a lot of time on the road with advisors, working with advisors, showing them how we operate, what we were doing when we were managing the mutual funds. And I know how difficult it is to have good client communication, to put your clients' assets in areas that you can believe in, that they trust you, and going forward, you wind up gathering more assets and building a better book. So I think what I'd like to do is glean a little bit of information. Where I'll start here is we were actually fortunate enough at Chaikin to ring the bell on NASDAQ about 2 weeks ago. There's Mark Chaikin on the right, me on the left, because we have teamed up with NASDAQ to produce 3 NASDAQ Chaikin indices that are all now 4 years old. And what's fun is 2 of them have been turned into ETFs through New York Life and Index IQ. And so I have been on the road quite a bit with mainstay wholesalers talking about the products, mainly just discussing the NASDAQ Chaikin indices and how they've done. And it was really kind of fun to be ringing the bell on the NASDAQ that morning. So let's go into what you'll discover today. And let's talk about how this is going to be a productive hour together. First of all, there are 4 things that we really want to convey today. 1, we want to show you how to avoid danger and risk, how to minimize client exposure to areas of the market that you don't want to be in, that are going to harm the returns of a portfolio. Number 2, we want to get some new ideas. We want to help you position for growth, help you and your clients actually make money in what is obviously a relatively more difficult market than we've seen in the last few years. Number 3, we want to help you enhance client communications. Client communication in this day and age is obviously as important as ever. We want to help you improve those communications, enhance them, and we have some tools that we think will help you do that in what we call done-for-you research. And then 4th, we want you to save time. Time is valuable. We have a lot of demands on our time. I know there are a lot of things that everybody wants to be doing. Sometimes sitting in an office is not among them. So the less time you need to spend finding great ideas for your client, and the more expediency you have in your process, the more time you'll have to do other things, and ultimately, we like to say we will end information overload. We'll start maybe with some context. I've always been a fan of charts. I know Marty Zweig was a huge fan of charts. He had copious charts on his desk. Mark Chaikin has always said, every good stock picker looks at a chart before he or she makes a decision, and I really agree with that. So I would like to add here also that a few months ago, Dan Russo came on board. He's a certified market technician, CMT, very involved in the New York CMT. He came on board as sort of our chief strategist, and has been writing commentary for us. Really, really powerful stuff. This weekend, he actually wrote the market insights for Mark, who is away on vacation. I know he's having a great time. We've touched base many times, but Mark is getting some good R&R. So Dan did market insights, and I will tell you that if there was one piece of information that you should have read over the weekend, it was his market insights. So Dan did a great job with that. He's continuing to do content for us and just really enjoying the commentary. The reason that's relevant here is he helped me put together a few of these charts. So the first one that we'll start with is the unemployment rate. And why is this important? Well, we know that unemployment goes down when obviously there's growth in the economy. And as a matter of fact, now what we've seen is the unemployment rate is the lowest it's been since the 1960s. And this is both the U3 and the U6 unemployment. So we're seeing broad-based improvement in employment, and even the labor participation rate is starting to rise. So you only see these conditions really when the economy is strong, and that is usually supportive of stock prices. Another thing that I like to look at is housing starts, because housing starts, as you can see from this chart, actually wind up being, and here I'm just with my cursor showing you in 2006 when the housing starts actually peaked. Housing starts have been remarkably good at pre-predicting recessions. In other words, you can go back to other peaks, you can go even back to the 70s, and you can see that these peaks in housing actually preceded the recessions, and thus preceded in many times the bear market. And at the moment, we've continued to see rising housing starts. And generally speaking, this is, again, a reasonably good indicator to look at to say that stock prices are probably in pretty good shape. Here is one of the leading economic indicators. It is, leading, quote unquote, only in the sense that in an amalgam of the 10 things that are in the leading economic indicators, they tend to start to slow down, or at least a little bit roll over ahead of recessions, although it tends to be somewhat more coincident. But here you can see, even back in the Great Recession, that it started to level off and start to drop before we actually got to the recession. And at the moment, we just got a new number out. They've continued to be strong. So once again, another thing that's showing some support for the overall broad market. GDP is another thing. So this is obviously a strong economy. We've seen GDP now above 3% for the first time in a long time. And this strength, continues to show why we've had a really good earnings season in Q1. This is a chart actually from Chaikin Analytics that shows where the S&P is at the moment. You can see that volatile period that we had in late January and February wound up putting us into kind of a consolidation period. And it appears now that we've broken out to the upside somewhat. And there could be a period of time here where, at least technically, the market looks somewhat better. The dollar also is one of the reasons I think we can look at and figure out that the market is doing better as a result of the dollar. And what's interesting about this is the dollar also tends to correlate when small caps outperform large caps. And we can talk about that a little bit in the call as well. But here the dollar is breaking out above its long-term trend line. Obviously retreated a little bit back here with some trade war talk. But generally speaking, we've seen a stronger dollar, which in turn has now led to the Russell 2000 starting to outperform the S&P 500. And Dan talked about that in his market insights. We've been talking about that for quite a while here at Chaikin, that there are a number of reasons why small caps look like a reasonable place over large caps at the moment. Although, as I mentioned before, we are still constructive really on both large and small cap. Here's the VIX. We all know we experienced an amazing amount of volatility, really brutal volatility in early February. The VIX last year, because of the nature of the market being so strong and really straight up last year, had gone to extremely low levels. So there was some inevitability of the volatility spiking, but how quickly it spiked and how violent the move was of course a surprise to many. However, here at Chaikin, we had been telling people, and we've done many of these webinars, and we've been out on the road talking to a lot of advisors such as yourselves, and said, there's still a lot of good things in this market. And while volatility is something to be afraid of, and we know it's something that it scares clients, it's a great opportunity as an advisor to really be a leader and sit down with your clients and talk through and let them know what your fundamental view of the market is and why you've placed their assets where you have, and why you're a necessary part of their success and their formula going forward to delivering great returns in their portfolios. So, client communication is key, and volatility can be a good thing because it gives you an opportunity to really talk to your clients directly. This is directly out of Chaikin Analytics, which is our online membership that we'll be talking about today. You can see here that what we've got is a very interesting look at last year and how strong the market was, and talking about the volatility, how it came down. This area here that we have the yellow highlight called Chaikin Money Flow is really key. As a former portfolio manager, and I know Mark mentions this often, sometimes as a manager you would want to exit a stock. Let's say you were selling IBM, and rather than buying something immediately, you wanted to still be fully invested for whatever reason, and you would buy the SPY. And so what we saw much of last year was the Chaikin Money Flow, the indication of institutional buying versus selling. You can see Chaikin Money Flow was very strong last year in the SPY, and that's one of the reasons why we had a very consistent pattern. What's interesting is as the selling really started, when we started seeing Chaikin Money Flow go negative, that's when we started getting the volatility. And so this is an example of a chart that's on Chaikin Analytics that really can kind of get granular and give you an idea of what's happening internally in the markets. The bottom area here is interesting because this is the relative strength of the S&P versus the small cap versus IWV. And it really, most of last year, as we know, large cap was outperforming small cap. And it really wasn't until the last few months that we started seeing the opposite happening. And that's kind of what this relative strength breakdown is that on a relative basis, we've actually seen small caps outperforming large caps. And that's one of the reasons why we do talk about small caps being in a good position. Putting some things into perspective here, declines in the S&P. I know many people have probably seen this, but it's very common to get at least one correction every year of 5 to 10%. They typically last about a month, which is kind of what happened in this last go around. About once every 3 years, we actually get a bear market. And some of them are obviously quite brutal. We've really only had 3 periods since the post-war period where we had a decline of 40% or more. And again, it doesn't appear at the moment like the preconditions of anything like that are brewing yet. So moving ahead here, with that context there, we would like to identify the early warning signs for you when to sell or reduce a position or get out of a stock or an ETF altogether. So avoiding danger and avoiding risk to minimize your client exposure. And then again, we'll go in and talk about growth ideas, new ideas, generating those ideas, helping you find stocks and ETFs. I know many of you kind of are moving away from doing individual stocks with a lot of your clients and doing ETFs. We have a way to look at ETFs and figure out which ones we think are positioned for best growth for your clients. We have an ability through our online platform to enhance client communication for you, done for you research, monitor those client portfolios and holding, and have instant access to research reports for nearly 5,000 stocks. These help you validate investment ideas with a third-party research. You differentiate yourself as an advisor, and it helps you have a communication tool with your clients. And then lastly, of course, we all want to save time, as we mentioned, so we need to analyze that information in as little time as possible and know and have a confident read on something, ending the information overload. Google is great. I mean, not necessarily saying anything about the stock. I mean, I use Google all the time, YouTube things, take a look at things online. There's a lot of information out there, but you can be overloaded if you get too much information. So danger and risk. How are we going to minimize client exposure to those risks and the danger in the market? Well, we'll start here with a little survey that was done by CNBC a number of months ago that asked clients, why did you originally select your financial advisor? And at the number one response was that he or she trusted you. If you're trusted, that is a very good start. Investment track record, though, was in second place, along with personalized service and customer service, which, if you combine those, actually wind up being maybe the largest bucket, because I kind of consider service, whether it's personalized or customer, to kind of be in the same bucket. And you can see between those things, they came to you because they trusted you, they believe your track record, and they believe you're going to do right by them in terms of getting them into the right areas of the market and avoiding the losers, and you gave them personalized service. One of the keys that I learned as a portfolio manager for as long as I was is that sometimes it's not the names that you own that wind up helping you the most. It's the ones that you were out of that would have caused the most damage. So sometimes by just being out of the worst names or having an understanding of what areas of the market are going to struggle, that is where you wind up doing the best. You need to be out of the names that are going to do the damage. So at Chaikin, we talk about, well, what does this danger actually look like? So thought we'd start with a couple charts. Here's Colgate-Palmolive. Everybody knows it very well, CL. It's in the Staples group. It's an area of the market that with the rising interest rates that we've seen, we've wound up seeing a lot of these yield plays really struggle. These defensive areas of the market have actually done remarkably poorly in what has been a very strong market. And we'll go into the whys when we start going into some of the details of the 20-factor model that we have. But let's look at this chart here for just a moment. You can see that the Chaikin money flow has been negative for a very long period of time. For the most part, institutions have been selling out of Colgate-Palmolive. And at the bottom, you can see that the relative strength that shows the stock versus the S&P 500 has been very weak. And our rating, which at the bottom is simply a red, green, or yellow bar, you can see that at the very bottom, we actually got quite bearish on Colgate-Palmolive earlier in the year. And the stock has really been kind of a one-way trip down. And that is kind of one of the areas of the market that you don't want to be in. The trends are weak. You can see this in the upper right. We give you a read of the trend of the stock. We give you a trend of the industry, and they're both weak. So you want to avoid stocks like this that in our system are bearish and that really don't look very good on a chart. Here's another one. This is PPL. It's a utility. We're here in Philadelphia, so this is a stock, obviously, that we know well. And again, in an area, utilities that have been relatively weak. Defensives and yield plays have been an area of the market you don't want to be in. The Chaikin Analytics tool has been recommending being out of these type of names for quite some time. You can see a quick read up on the left here that the stock is very bearish, And indeed, for a long period of time, we've actually seen relative strength of this name be quite negative and institutional selling. So the market has really been agreeing with the model. The market has not liked this stock. It's been down. Institutions have been selling it, and the Chaikin Power Gauge has been bearish on this name for quite some time. Here we highlight the 4 areas of the market that we do look at, and you can see whether you're looking at the financial metrics, which we'll go into in a little bit, earnings, technicals, or expert opinions, they've all been negative on this stock. So now that we've kind of gotten a picture of what a bad stock looks like in areas of the market that you might want to avoid, I'll introduce what the Chaikin Power Gauge rating is. It is a clear summary of a stock's potential, and what you'll see is that it has a history of actually delivering alpha. And it is a simple way of looking at the market, but there's nothing simplistic about what is underneath the engine and how this works. It's a 20-factor quantitative model that Mark developed really as more of a research project back in 2009 and 2010. Took him almost 2 years to come up with the 20 factors by iterating them multiple times in his system and looking at how various factors, various fundamental ideas work in tandem. It was an area of the market that really does combine fundamentals, technicals, earnings, and expert opinions into a single rating. When I was at various mutual fund companies, commonly would have some version of a quantitative model, and I can tell you that this one is the best I've ever seen. And we're going to spend a little time on going through some of these 4 primary factors that Mark hit upon. As a portfolio manager, and I know many of you do this even with your own portfolios, there are certain things that analysts always look at. And many analysts wind up having a bias in one direction or another. They're more of a value manager, they're more of a growth manager, maybe they love earnings surprise. And in my opinion, you really need to be able to look at all of these things, and the Chaikin Power Gauge does it with one simple rating. So in financials, which is really like the bedrock of the model, these are the value indicators. These are sort of the value factors that we look at. When I was a portfolio manager, I was always a big fan of Warren Buffett. We all know that Warren Buffett loves free cash flow. Free cash flow is something that's very important to Warren. Look at his buy of Apple recently, high free cash flow company. So free cash flow for Warren is one of those non-negotiables. It happens to be one of the largest weightings even in our model. Some investors that are more value-oriented, like Seth Klarman, he loves price to sales. Price to sales has a very good long-term track record of actually identifying good stocks. You don't typically want to be in stocks with high price to sales, especially if then their earnings, and that's where we look at the growth metrics. I've always been a believer that you want to look at the growth metrics. Growth at a reasonable price is something that I think all investors can believe in, and the model identifies not just companies that have good value metrics or good financial metrics, but also have good earnings growth. And what's interesting is what happens with earnings growth. Well, as long as I've been around, and even Mark talks about this, and Mark's been on Wall Street for 50 years, what hasn't changed is that if a company reports an earnings surprise, then what happens next? The earnings estimate trend goes up. If the earnings estimate trend is going up, what typically happens? Then an analyst rating gets upgraded. So there's a really good positive feedback loop with a lot of these factors that are in our model. And the thing is that you will not see many quantitative processes that utilize expert opinions, or as we call it sometimes, sentiment. Sentiment is like our secret sauce, insider activity. I mean, who better than the insiders to bring out their own checkbook and buy their own stock? Who better than them knows what their stock is going to do in the next 12 to 18 months? So if the insiders are buying, that's a very good thing. If they're selling, conversely, that's a negative. So these 20 factors, and of course, while fundamentals drive stock prices, 85% of our model is fundamental, technicals are still important. And that's a lot of the things that we look at. You can see that Chaikin money flow is one of the technical indicators in there, as is the price trend rate of change and the price trend. So 15% of the model is technical, 85% of the model is fundamental, and the fundamentals drive stock prices. Here is a chart of the performance of the power gauge. And this is really where the rubber hits the road. This is the why do I trust it? Well, since 1999, so this is obviously a combination of back testing and what we would call real world performance. And I realize nobody shows you a bad back test, so we've got another thing to show you next. But this is what we have done with the Chaikin analytic tool. This is the power gauge in practice. Here is where the very bearish stocks, the bearish, the neutral, the bullish, and the very bullish, how they have done in the last 18 years. And you can see that if you had parked yourself in the bullish and very bullish stocks, you would have beaten the benchmarks. And that is the idea. Furthermore, avoiding the bearish and the very bearish, you are getting out of the way of the danger. Here is actual live 4-year track record of our 3 NASDAQ Chaikin indices. I mentioned the ringing of the bell. 2 of these are actually out as ETFs now, and they are based off of the NASDAQ Chaikin indexes. So here you can see that in a 4-year and change live track record, these are only rebalanced annually, which is another thing that I think is very unique, is that we monthly rebalance. Most everybody shows you back tests on a monthly basis. These were actually only rebalanced annually because NASDAQ only rebalances their own indexes annually. So we enhance them by overlaying the power gauge on the NASDAQ indices, large, small, dividend achiever, and you can see the kind of alpha that we've generated. So the excess return is more proof of concept that by overlaying the power gauge, we can find stocks that are going to outperform. And this works for any number of indices. Here's a little shout out from Jim Cramer. Mark was actually up doing some really great stuff with Jim. They had a conference together in New York late October of last year. Jim Cramer tweeted out, Chaikin Analytics model is the best, used it at my old hedge fund. It was very nice of him. Then Mark and Jim went on to do a joint webinar for only our members and his members in late January, kind of a what to look for in 2018. It was really a great event. Many of our members said it was one of the best things that they saw that year. So the key thing is avoid the areas where there are problematic names, because those are the areas where you're going to lose money. And we will talk a little bit more about how we can find those areas. How do you identify those risks? Here's the easiest way that I've ever seen done, and the way that I do it in my own portfolio. I use the Chaikin Power Bar. Well, what is the Power Bar? The Power Bar is simply taking any ETF or any index, any sector, and looking at how many stocks are bullish and very bullish versus how many are bearish or very bearish. We call it the bull-bear ratio. It demonstrates you can put a client portfolio through the Chaikin Power Bar, and you can wind up getting a very quick read on what the danger level of that portfolio is based on what the Chaikin Power Gauge is saying of every name in that portfolio. So again, I use it in mine. It's a powerful tool. Here's a great way that I've used it. You look right now at the 11 sector spiders. You can see that energy, financials, healthcare, and technology are currently at the top. In other words, in the energy land, there are 11 names that are currently bullish or very bullish, which is relevant because we'll show you a few things within energy, one of our screener tools. And there are 3 names that are bearish or very bearish. So energy right now has a very good bull-bear ratio. Energy is a sector where we believe is happy hunting grounds for you and your client portfolios. Similarly, financials, healthcare, technology, all still good. What do you want to avoid? Well, at the very bottom is real estate. Dan Russo did a really good write-up recently about how at the moment real estate is probably good hunting ground for short candidates. You don't want to own REITs right now. Utilities are sort of the same way, and staples. So the weakest areas of the market right now are staples, utility, and real estate. They're areas of the market that you likely want to avoid getting your clients into. Well, with all the talk of where you don't want to be, now I think we should also talk about where we do want to be. And I think positioning for growth is something that clearly we all want. Your clients are with you because they're hoping to retire one day. Their portfolio is very important. That's in many times their entire life savings, and they want to, grow it. They want to find areas that can do well. So we've introduced the idea of the power bar. So which sectors and industries do well? Well, we'll go to just a chart that we found that we've actually been using now for almost a year. And it's interesting because it's been remarkably accurate. And that is that sector performance when interest rates are rising. And it stands to reason that the interest rate sensitive areas, utilities, telecom, consumer staples, and to some degree healthcare, are areas that you want to avoid during a rising rate environment. Whereas financials, industrials, technology, energy, materials are those areas that you would want to target when interest rates are rising. Now, we don't know for sure that interest rates are going to continue to rise. It seems like they will. The Fed's kind of telegraphed that they're likely going to continue to raise interest rates. We know the 10-year has now kind of been staying above 3% more often than not. Feels a little bit like the interest rate cycle is turning. Been clearly an amazing bull market for bonds dating all the way back to the early 80s. And now it seems like interest rates are starting to rise. And indeed, these are the areas of the market that have been doing the worst. So going back to our original premise here, coming straight from Chaikin Analytics, here are the areas that I would be focused on. And I think if you looked at this, many of our members do the same thing. As an advisor, you sit down with clients trying to figure out what to do with the portfolio. These are the areas of the market that we would be focused on. We would start looking at the sectors, saying which sectors are the areas of the market that we want to wind up investing in. So we did in our Chaikin Analytic tool. It's very quick, very easy. When I came on board, I was always an eat my own cooking kind of guy. I wound up selling the mutual funds that I had managed for many, many years and rebuilt my own portfolio using the screener tool in Chaikin Analytics. Screener is great. It's very easy. You just wind up throwing whatever you want in here. You could do much more broad-based. You could put the S&P 500, Russell 3000, whatever you want. Here, what we decided to do is select a sector and say, well, if we just wanted to buy a few energy stocks, how would we do it? Well, throw in the energy sector, and as we had pointed out earlier, there were 11 bullish and very bullish stocks. That's what happened. We screened for just bullish stocks within energy, and these are the 11 names that came up. So this was done this morning. You can see that obviously Marathon, Phillips, Valero, all doing really well today. And you go to the charts and you look, here's Valero. So this is an example of a name that we've been bullish on for quite some time. You had great opportunity to get into this name. And this is exactly the type of charting that we look at Chaikin Analytics. I think it's a quick picture. Many of you I know would make great use of this because here you go. This is what we were talking about earlier, Chaikin money flow. Institutions buying it. If the institutions are buying it, if the large mutual funds and hedge funds are out buying a stock, there's a tailwind that's going to drive the price higher. That's where you really want to put your client assets. You want to follow the market, and our model has been constructive on this stock for virtually this entire run in this name. It remains very good. You can see those four primary factors that we talked about: financials, earnings, technicals, and expert opinions that we've put here on the left. They're all demonstrating that there is a lot of tailwind to this name. So there's an example of stock that you do want to own. Chaikin Analytics has been very much bullish on this name for a good chunk of this ride. Same space, energy, Holly Frontier. I just was doing some research and I had forgotten that about 2 weeks ago, Mark had made this the stock of the week, and it's done nothing but go up. So again, in an area, energy, power bar is bullish, stock is very bullish in Chaikin Analytics. We've got very solid money flow, institutions buying the stock. Relative strength, which is listed here, is strong as well. Relative strength is an area where you want to be buying stocks that have strength. In general, technically, it means the stock is doing well. And ultimately, the power gauge is your true gauge of what you want to do. Very quick, powerful, easy to use. It's telling you the stock is very bullish. Another name that we've liked for quite some time that continues to look very good, both on the charts and the way it's behaving in the market. Technology was another area that we mentioned where we believe there's a lot of good things happening. What I like about this one is it actually also shows what we would call a personality change. Personality change is a stock that either had been outperforming that starts underperforming the market, or in this case, it's a stock, and you can see where the yellow circle is here. It's a name that had been underperforming the market. The S&P had been outperforming. We know that many other technology, a lot of the FANG stocks have been doing remarkably well. Semiconductors were an area of the market that had been doing very well. We've been bullish on Micron and some of the other ones also in the system for quite a while. But Akamai was a relative laggard. They actually, interestingly, came out with a somewhat disappointing, you can see that in red, earnings report. However, the stock rallied on that. And there were a lot of other things that were going on. We were starting to see expert opinions. We were starting to see analysts up their forecasts. Financial metrics, and the growth metrics, the earnings are both quite good. So really, we saw that personality change, and the model would have gotten you in a little earlier, and you would have actually wound up having a nice run here. Then you got an upgrade, and you can see that the chart has continued to look very good. So what's happened here is we've seen a little bit of back and forth, creating the volatility in the name to some degree, but now we're starting to see money flow be very positive. It's in an industry group that is showing very good Chaikin power bar, and this is a stock that is outperforming, and we've got a very bullish rating in the power gauge on this. It's another good example of a name and potential area of the market that looks compelling. This is what we would be focused on, and I think makes sense for you and your clients. Moving on a little bit, because I know we've talked a lot about individual stocks. Clearly, there's a movement to ETFs, and this is another area of the market where the Chaikin Analytics tool can really be helpful. We have any number of ETFs that you can look at. You can do an ETF comparison by sector, by style, by strategy, by issuer, and when you populate it, what you would see is the same thing we've done here for the sector spiders. You would see every one, let's say you did large cap core, you would then get a list of 90 some odd large cap core ETFs, and you would get a power bar rating on every one of them. That would give you, I think, the confidence to understand that the ones that have the best power bar are the ones with a third-party independent research. At Chaikin, we like to talk about the fact that we understand a lot of your research departments are challenged. They have not put out research reports that maybe you feel compelled by, and to really differentiate yourself with your clients, it's nice to have a third-party independent research tool. So here you can see what all the top holdings are. We give you the cost. You can see what the actual performance is. You can sort by week, month, 3 month, 6 month, 1 year performance, and again get an idea of the assets of any given ETF, and do your homework in one convenient place. Get the actual cost of the expense ratio. So, in this case, the XLE charges 12 basis points. Every ETF would actually have whatever expense ratio they have. The dividend yield that you get, the AUM, the volume that you see, the beta. Got a lot of good information for you right here on an ETF screener. So even if you're not doing individual stocks with many of your clients, you're just using it as an ETF tool, you get a very quick and easy read on ETFs through our ETF screener. So enhancing client communication. We know that every day you sit down and you're thinking about, how am I going to keep my clients happy? How am I going to get new clients? What am I going to do to prospect for new clients? And how am I going to use the tools that I do have as client acquisition vehicles and tools? So going back to that same CNBC study that I think is really a good one for our business, what were the primary reasons that people switched from their advisor in the last 10 years? These are areas where poor customer service, lack of personal attention, so the opposite of what we saw on the good side, and then of course there's the poor investment track record. So you aggregate those three, it's roughly 28%. So a little less than a third of the customers are leaving, their clients are leaving an advisor because they feel like they're not getting customer service and they're not getting quality personal attention, along with poor investment track record. And it's really those things that we think, as a client acquisition tool, you can utilize Chaikin Analytics. Here's what we call the Chaikin Portfolio Health Check. The way I would use it with my clients is invite them in, put their portfolio, maybe it's a prospect, say, hey, I'd love to sit down with you. Why don't you let me know what you own? We can go through it. You immediately can put it in a portfolio health check, and you get a very quick read. Same idea. The prognosis is up at the top. It's a power bar of their individual portfolio. So in this case, we just threw the S&P 500 back in March through it. You can see that 119 names were bullish or very bullish, 79 were very bearish or bearish. Those are the areas you wanted to avoid. Very easy conversation with the client to have. Listen, we think you should be out of these names because, third-party independent research is showing that it's an area of the market that you want to avoid. We would rather focus your portfolio in the areas that we think are going to outperform. You also get a very good picture for your client. It's what we call the power grid. It's a diagnostic tool that works in seconds. Put the name in, very easy to load a portfolio, and there you can see you really want to be focused on strong groups. And in this case, when it was done, it was the banks, aerospace, defense, computer software, etc., that were all areas of the market that you wanted to be in. And then, of course, you wanted those strong stocks within those strong groups. Areas like down here, weak groups with weak stocks, that was the area of the market that you wanted to avoid. Those were the areas that we talked about with the power bar. Very quick and easy to use. Great client acquisition tool, something that when I've been on the road talking with various advisors and I show them this, I've got my own portfolio in there and they're like, wow, that is really slick. And you show this to a client and you immediately can see their eyes light up with something different. You can also get third-party independent power gauge reports on any stock. We have roughly nearly 5,000 stocks, and if you get a call from a client, maybe you haven't even heard of the stock, you just quickly type in the ticker symbol, and you can get a very quick read on that stock, look pretty smart, tell the client immediately, well, price to sales looks a little expensive on that name, but growth is very good. The earnings picture has been very bright on this name. And then you can actually print out this report and show them as a PDF, third-party independent research on any given name. Really, I think, great client engagement tool. Here's Tim, who's actually a Chaikin Analytics member. He had a really nice shout out for us. He said, I cannot express how well received this has been. Clients love the information, and more importantly, they trust the information. In one situation, the client invested an additional $500,000 in her portfolio just because she could see that my recommendations were supported by your research. We've kind of heard this mantra over and over. Once people utilize the tools, once the advisors have it in their hand, it's one of those things that it's a time saver. It's really easy to get reports, and you get your clients engaged. And frankly, they trust you more for it, which is both a great client acquisition and client retention tool. So, get a quick read, a confident read on any stock. That's how I've used it. Friends call me. They used to call me all the time and say, hey, what do you think about Applied Materials? What do you think about Micron? What do you think about Berkshire? Whatever it is. And, we would go into the weeds. Maybe I'd read a report, take a lot of time. Now, I just pull up the Chaikin Power Gauge rating of the stock, and I immediately get a very quick and confident read on any given stock. I can get more granular by printing out that power gauge report, or you just pull it up and you look at a chart and you immediately have it at your fingertips. So this all leads to the fourth point that we're driving home here, is saving you time. Everything you need to know is in one place. You load the system up. You can call your clients. You can engage with your clients, you can engage with your colleagues, you can ask for referrals, and you can get people on the phone and really have a confident read in one place that's very quick and very easy. Barron's gave us a nice compliment. They had named Chaikin Analytics as one of the top websites for quantitative stock analysis. One of those great things is even looking at John Malden. I think many of you know who John Malden is. He's one of the country's best sort of third-party independent economist out there, and we've teamed up with him on a number of things, and he is a Chaikin Analytics user. He's really found that integrating it into his routine for due diligence, for vetting and evaluating different investments, that Chaikin Analytics has been one of his go-to sites to figure out what his portfolio will look like. So just in conclusion here, going through 20-factor model combines fundamentals. We know fundamentals drive stock prices, but we need confirmation from the technicals. And so a combination of those fundamental and technical factors works best. One of the tools in there also won us the Benzinga FinTech Award last year. There were a number of entries. I think there were 17 or 18. We won it. And it was what we call Pandora for stocks. You plug in a name. Let's say it winds up being something like Chipotle, which has been very difficult. It will then give you stocks like Chipotle, maybe some avoids, and then it'll give you some swap ideas. So in this case, we've got Excellus up there, and you can see that you can do a swap with that, and then down below you would have short candidates or avoid candidates below it. So very quick, very easy. If you know what you're looking for, it will share with you other ideas that you could look at as well. Ultimately, screening for winners is what I do. I reconstructed my own portfolio using the screening tool. I think the screening tool is a great way to go out and find stocks. For those of you that do options, we have a fully integrated options play with Chaikin Analytics. So you can go in there and actually find names maybe that you're bullish on. Chaikin Analytics, the power gauge is bullish on a name. You can create different bullish spreads in the options by utilizing the options play link, and it winds up then with any clients that you have an options focus with, very seamless and easy to use. Great idea generation through options play. My favorite part of the tool, other than the screener, is the ETF. I know many of you use ETFs. We've already kind of talked about this, but here it is in more granular detail about what you can screen for. So you can go for style over here on the left. If your client is looking for a small cap blend portfolio, you just click on small cap blend. It'll populate all of the small cap blends, first listing them by what the most bullish power bar is. In other words, where we see the most opportunity. It gives you all the performance metrics, and then very quick and easy read of what's both in it and what they're charging for the ETF. And for that matter, liquidity, size, whatnot. So usually Chaikin Analytics is $2,195 a year. I always chuckle at that because as a portfolio manager, I used Bloomberg, and that's about what Bloomberg costs a month. And I feel like at least we're giving you really solid recommendations. I think $2,195 a year is already a bargain for what you wind up getting. But right now we're doing a webinar special. This is really for you. It'll go until this Sunday, but you save $400. That's almost 20% off of the usual price of Chaikin Analytics. So for $17.95, you get all of what we've been talking about. And what I'd also like to highlight again is, as a member, you get some support resources that only you have access to. We talked about weekly commentaries. Dan Russo did it this last week. Mark, who's been around for 50 years, has a great weekly commentary, gives investment ideas. We talked about how Marathon Petroleum was one from a couple weeks ago. It's done nothing but go up. Daily commentary also from Dan Russo. We keep you abreast of things. We have a great onboarding team, some of the best client success people really in the business. So the four things again: avoiding danger and risk to minimize client exposure. At Chaikin Analytics, we help you identify the early warning signs of when to sell or reduce a position. 2, positioning your clients' assets for growth, generating new ideas. We can help you find those stocks and ETFs with the highest potential to outperform. We're seeing some more volatility in this market, but people still want to invest for growth. 3rd, enhancing the client communication, done for you research, easy to log in, immediate information at your fingertips. You can convey that to your client both by printing out PDFs, by putting it into a client portfolio in there and doing a portfolio health check and looking for new ideas in ETFs. But enhancing client communication, really engaging with your clients, or even more importantly, those prospect clients. And then lastly, saving you time. No information overload here. It's all in one place. Get a great read on a stock, very easy to use. Really, once you engage this into your system, into your overall daily routine, it becomes very easy and it saves you time. So again, really appreciate your time. I think being a member of Chaikin Analytics has all sorts of benefits. It's a system that I have enhanced my own returns utilizing Chaikin Analytics. Really find it both powerful, useful, and as the data had shown you with the 4-year track record, live track record of the 3 indices with NASDAQ, proven track record of performance. So thanks very much, everybody, for your time. Appreciate it, and really hope to see you as a member at Chaikin Analytics. You won't regret it.
Thank you, Carlton. Thank you, everybody, for joining us. In the chat window, I have placed a link which you can click on to go directly to the offer that Carlton just spoke about, or you can call us at 877-697-6783. We do support sessions all the time. We have a great client success team. We can have you on an onboard tomorrow. We can have you walking through and learning the program as early as tomorrow. Again, that number, 877-697-6783. 83, or you can click on the link in the chat window. This session was recorded, and a recording of it will be sent to all participants, all registrants, tomorrow morning. Thank you all for your time. We look forward to seeing you in the future.